Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So it's a new year, but it's kind of deja vu all over again. Deja vu literally means already seen. And it's like, yeah, I've seen this play before. I feel like we're back in 2019. And by the way, that's not necessarily a good thing. Today, I'm going to explain how the current setup in the financial system looks a lot like it did the year before COVID and what that might portend. So before we get into that, I hope everybody had a fantastic New Year holiday. We certainly did here at the Maharrey household, and excited about getting into 2026. As always, I do want to thank you for listening to the show. I know there's a lot of stuff out there vying for your attention, and I appreciate the fact that you spend a little bit of time each week with me. And if you would do me a favor, I would really appreciate it if you would go to wherever you listen to the show and give us a review. Give us those 5 stars. Share these episodes on your own social media channels. If you find value in the show, I'm sure other people that you know will as well. And it would help us grow the show. And I would say thank you very much. So we had this big correction in gold and silver a couple of weeks ago. And we've already recovered a big chunk of that. This morning, gold was down about $50 off of yesterday, but it's still over $4,450 an ounce. And remember, when it corrected, it fell down into the 4330s. And meanwhile, silver is currently just over $78 an ounce, and it was flirting with $80 again yesterday. It dropped down into the low 70s when it corrected. Now, it's interesting because every time the metals dip, every time we get these big corrections, we get the mainstream pundits telling us that the gold bubble has popped and silver has topped. And yet, for 2 years, the metals have been defying these naysayers. I remember around this time last year, a lot of people were saying, yeah, 2024 was great for gold and silver, but things are probably going to normalize. The bull market's probably run its course. Well, if by normalize, they meant gold would be up over 64% and silver up just under 148% in 2025, yeah, they were spot on. And, by the way, I'm not making price predictions here. I'm just saying that the dynamics that are driving these metals higher are still in place today. And that's why every correction does not spell doom for the bull market. Now, we do have a lot of volatility in the precious metals markets. Actually, gold volatility isn't even really high from an historical standpoint, but it is there. I did an article this week on gold volatility, and I'll link to that in the show notes page if you want to look a little bit more about these kind of wide price swings and what that might be telling us. But today, I want to get into exactly where we are in the business cycle and what that likely means if history is any indication. Now, keep in mind, history doesn't always repeat, but it often rhymes. And I think we're in a very similar setup as we were back in 2019 before the COVID pandemic. And I kind of want to trace that out because I think it's really important. This will help you understand why precious metals are doing what they're doing, bigger picture, kind of backing away from all of the volatility and the price up and down. Why do we have this gold market to begin with? Well, I think that these dynamics kind of help underpin what's going on. And before I get into the current economic setup, I want to go back in time. I want to do a little bit of a review of the Austrian business cycle and how that has played out really since the 1980s. I'm a firm believer that one cannot grasp the economic big picture without understanding how the Federal Reserve's monetary policy drives a boom-bust cycle. The effects of all of the other government policies that we see, taxation and regulation and all of these things, work within the Fed's monetary framework. Money printing and interest rate manipulations fuel booms, and the inevitable attempt to return to quote-unquote normalcy precipitates busts. So in the simplest terms, easy money blows up bubbles, bubbles pop, set off a crisis, rinse, wash, repeat. Now, in practice, when the economy slows down or enters into a recession, the central bank, like the Federal Reserve, drives interest rates down, and launches quantitative easing programs, QE for short, which are designed to stimulate the economy, right? Low interest rates encourage borrowing and spending. The flood of cheap money suddenly available allows consumers to consume more, thus the stimulus. But of course, it also incentivizes corporations and government entities to borrow and spend. Coupled with quantitative easing, the central bank can pump billions of dollars of new money into the economy through this loose monetary policy. This has been going on since the 1990s when the Fed pushed rates down and managed to blow up the dot-com bubble. Now, in effect, we talk about quantitative easing. What is that? Well, it's a fancy term for printing a lot of money. Right. Now, the Fed doesn't literally have a printing press in the basement of the Eccles building. It's not running off dollar bills, but it generates the same practical effect. The Fed digitally creates money out of thin air, and it uses those new dollars to buy securities and government bonds, thereby putting cash, new money, directly into circulation. QE not only boosts the amount of money in the economy, it also has a secondary function. As the Federal Reserve buys U.S. Treasury bond, it's buying U.S. debt. It's actually monetizing government debt. It's taking government debt, it's turning it into money and injecting it into the economy. The central bank can also buy financial instruments like mortgage-backed securities, as it did during QE in 2008. It also did it again during the pandemic. This effectively serves as a bank bailout. Big banks get to remove these worthless or undervalued assets from their balance sheet and shift them over to the Fed. So theoretically, this makes the banks more solvent and encourages them to lend more money to ease the credit crunch that occurs when banks become financially shaky. So all of this monetary policy results in this temporary boom. All of that new money's got to go somewhere. You know, it could result in rising consumer prices, price inflation, which is what we saw after the pandemic. But generally, it pumps up the price of assets, such as real estate and stock markets. It creates this fake wealth effect, right? People feel wealthier because they see the value of their assets, their stocks, their houses, rapidly increasing. With plenty of debt-driven spending and rapidly increasing asset prices, the economy grows, sometimes grows at a staggeringly fast rate, and everybody's happy and exciting, and there's all this exuberance, and everything is great. So this surging economic growth and shrinking unemployment, along with the rising stock market driven by money creation, give this illusion of a healthy economy. But the monetary policy is actually hiding the economic rot at the foundation and contributing to more economic rot, right? In order to sustain an economic expansion, you got to have capital goods. You need stuff, right? Factories, machines, natural resources, right? Capital goods are produced through savings and investment. If you don't have savings and investment, you don't have capital good creation. If you don't have capital goods creation, you can't have a growing economy over the long term. When central banks juice consumption without the requisite underlying capital structure, it will eventually become impossible to maintain, right? You can print all of the dollars you want, but you can't print stuff. So at some point, this credit-driven expansion is going to outstrip the available stock of capital, and at that point, the house of cards begins to collapse. Think of it this way. Imagine that you want to build a giant brick wall, right? With interest rates low and credit readily available, you borrow all the money you need to complete the job. But 2/3 of the way through, there's a brick shortage. You may have plenty of money. You've got all of this cash, but you've got no bricks. You can't finish the project. Money has outstripped the stuff, right? Or outpaced the stuff. So this scenario provides a really simplified picture of what happens in the economy during a Fed-fueled economic expansion. Flush with cash, investors begin all kinds of projects they will never be able to complete. And eventually the malinvestments will become apparent and the boom teeters and then collapses into a bust. Now, the Fed helps this process along as well, right? Once the apparent recovery takes hold, you got to keep inflation under control. You can't just endlessly inject money into an economy. The modern monetary theorist notwithstanding. So in order to keep inflation under control, the Fed has got to tighten monetary policy. It ends its quantitative easing programs. It begins to nudge interest rates back up. When the recovery appears to be in full swing, the central bank may even shift to quantitative tightening or shrinking its balance sheet, which is exactly what it did a long time after the 2008 financial crisis and then after the pandemic. So what happens during the boom? Well, governments and consumers and companies, they pile up enormous amounts of debt, right? It's incentivized. Interest rates are artificially low, so everybody's borrowing. And we end up with a debt black hole, which is exactly what we're experiencing now. I've talked about this on the show before, the evolution of the debt black hole and how it impacts and warps everything in the economy. We have that now. So when the Fed has to start raising interest rates in order to keep inflation at bay, this increases the cost of servicing all of that debt. And it also discourages new borrowing. Easy money dries up, and this speeds up the onset of the next recession, and the cycle repeats itself. Now, if this sounds familiar, it should, right? We can trace this all the way back to the late 1980s. Go back to October 1987. We had a big stock market crash that year. The following year, inflation rose above 5%, and that prompted then Fed Chairman Alan Greenspan to raise interest rates above 9% in early 1989, which led to a mild recession in the early 1990s. So, in response, Greenspan pushed rates below 3% in late 1992. Now, 3%, that's basically where we are now. But 1992, that was really, really low. And then he slowly began to nudge them back in 1994. But the Feds never got rates anywhere near that pre-recession level. With the economy plugging along, rates peaked at 6% in 1995. From there, Greenspan held rates in the 5 to 6% range through 2001. And then the dot-com bubble popped in the spring of 2001. It was inevitable, right? We have a higher interest rate environment. We have all this borrowing, all of this exuberance. Finally, the bottom blows out, and we have the dot-com bubble pop. So what did Greenspan do? Well, he slashed rates again. This time he dropped them all the way down to 1% in June 2003, and this set the stage for the 2008 financial crisis. Now, one of the things that you will notice if you look at the trajectory of interest rates over time, they start at a level. We have a recession. The Fed drops those down to stimulate the economy in the recession. The thing is, every time they have to drop them lower than they did before. And then when they raise interest rates again to normalize, they never get as high as it used to be, right? So we had this pattern play out, and it played out again. We ended up with the 2008 financial crisis. This is why I like to use the heroin analogy, because money printing is basically monetary heroin. The Fed has addicted the economy to this easy money drug, and it takes more and more of the drug every time to get the same effect. So you have to cut rates more. You have to do more money printing and quantitative easing in order to get the stimulative effect. And then when you start trying to normalize, well, the drug-addicted economy, it needs that drug, so it can't handle being cut off, right? So we get this business cycle and a ratchet effect, a downward ratchet effect in interest rates over time. More and more easy money, that means more and more inflation. So with that background in place, that kind of pattern in the business cycle, let's fast forward to today. Where are we today? Well, where we are is in the midst of a lot of turmoil in the financial system. And I think that the bull market in gold and silver over the last couple of years is really reflecting that turmoil. It's a kind of a symptom, a canary in the coal mine, if you will. But there are other signs that we're having this financial system stress. And one of those is in the increase in what are known as repo operations. I'm not talking about somebody repossessing a car or something like that. I'm talking about operations where banks borrow money from the Fed for a very short term, overnight, generally speaking. So banks and other financial institutions borrowed $74.6 billion from the New York Fed's standing overnight repo facility, on the final day of 2025. The last time we saw this kind of a spike in repo operations was in the months before the COVID-19 pandemic, as the stock market was tanking and the economy was going into spasms after the central bank began trying to normalize interest rates in the wake of the Great Recession. Now, in here in a minute, I'm going to get into how what we're seeing today parallels then and what that means. But first, let me just kind of run through what's happening right now. Repurchase operations or repo operations are an important aspect of the banking system. The repo market enables banks to borrow cash for a very short term to maintain liquidity and meet daily financing needs. In a repo trade, a financial firm puts up treasuries, bonds, or other quote-unquote high-quality securities, usually mortgage-backed securities, as collateral for a short-term loan. So then the firm repurchases the bonds, paying a nominal rate of interest, usually within 24 hours. So it's basically just a very short loan that's backed up by treasuries or mortgage-backed securities. So on December 31st, banks and other financial institutions put up $31.5 billion in treasuries, along with an additional $43.1 billion in mortgage-backed securities to secure overnight loans at the Fed repo facility. Now, repo operations typically occur among private entities based on the market interest rate. A rise in the repo rate implies a shortage of available short-term cash. According to Reuters, the general collateral repo rate on the open market was about 3.9% on early Wednesday before the end of the year. That was higher than the Fed repo rate of 3.75%. So this spread, which was growing because of a shortage of available short-term cash, this incentivized firms to borrow from the Fed at the cheaper rate. So in effect, the Fed's repo facility functions as a liquidity backstop. So between May 2020 and August 2024, the Fed's repo facility was scarcely used at all. And I will link to a chart or put a chart on the show notes page at moneymetals.com/news that shows the use of the Fed repo facility. Now, just because they weren't using the Fed facility doesn't mean there were no repo operations. They were just facilitated through private lenders. When repo volumes at the Fed facility spike, it usually implies that the private repo supply isn't meeting the market's need at reasonable interest rates. There was a small spike in the use of the Fed repo facility in September 2024 before it really began to climb in June of last year as the second quarter ended. Now, repo activities often jump at the close of a quarter or at the end of a year because big banks and dealers that normally intermediate operations temporarily become what they call balance sheet constrained. They're basically trying to make their financial position look as strong as possible for those end of the year reports. Meanwhile, there are still other financial entities that need access to short-term cash. So you've got the people that are normally doing the repo operations, they're holding the cash on their balance sheet because they don't want their balance sheet to look cash poor. So this year-end spike in repo operations is notable due to its high volume. As noted, we haven't seen this much activity in the Fed repo facility since September 2019. And that September 2019 thing is significant. I'm getting to that because that's really the crux of where I'm going with this. The mainstream financial media, of course, downplayed the Fed repo spike. Reuters reported, quote, "Most expect Wednesday's borrowing surge will dissipate over the coming days as more normal trading conditions reassert themselves." However, firms had already posted $19.5 billion in treasuries at the facility as of January 3rd, 2026. So they were still using it. It hadn't quite normalized yet. Meanwhile, the Federal Reserve fulfilled its promise to restart quantitative easing. Now, of course, they're not calling it quantitative easing, but the effect is the same. And I talked about this on the show a couple of weeks ago. At the December meeting, Jerome Powell and his minions basically said, we're going to start doing quantitative easing again. Again, they didn't use those terms. They're not going to say those words, but this is what they're doing. And if we look at the Fed's balance sheet, it bottomed on December 3rd at $6.54 trillion. Then at the December meeting, which was on December 10th, the Fed announced that it would purchase $40 million in Treasury bills the following Friday. And bills are short-term treasuries that mature in 1 year or less. And then from that point, they said the purchases will remain elevated for a few months before they are significantly reduced. Since then, the balance sheet has increased by $104.8 billion. This is, by definition, inflation. So while the mainstream generally insists that these operations are no big deal, they're just meant to keep the financial system's plumbing clear, it's more likely signaling a deep amount of stress in the system due to higher interest rates, right? Simply put, an economy and a financial system that is addicted to easy money can't function in a higher rate environment, especially when that monetary policy has already incentivized a giant debt black hole. And that's why so many people are desperate for rate cuts right now, despite the fact that we still have price inflation that's well above the 2% target. And as I have been alluding to, we have seen this show before. So this is where we get to the parallels between today and 2019. Go back to the 2008 financial crisis, right? System crashed. The Fed bought more than $3.5 trillion in bonds via quantitative easing in the wake of that financial crisis. And then banks built up massive cash reserves at the Fed. And that level peaked at around $2.8 trillion, the amount of money that was at the Fed. So these available funds. That began to drop in 2015 when the Fed started raising interest rates. Now note, we had the financial crisis in 2008. The Fed didn't get around to even trying to normalize things for 7 years, 2015. And it really didn't start in earnest until a year after that, right? So this decline in bank reserves accelerated when the central bank began its balance sheet reduction operation, and that was in October 2017, and more aggressively hiked rates. So this is what we just did after the pandemic, right? We had this bout of inflation, then the Fed stepped in, it began raising interest rates, it began balance sheet reduction, quantitative tightening, and here we are, right? So in the fall of 2018, the economy began to crack under the Fed's monetary tightening. The stock market tanked, the economy was getting wobbly, and the Fed was forced to cut rates 3 times in 2019 and resume quantitative easing just like it did in December. Now, again, in 2019, they didn't call it quantitative easing. They swore that it was just, these temporary operations to keep the plumbing in the financial system money. They like to use that plumbing analogy, by the way, which is fitting, considering most of what they're pumping through there is what. Anyway, I digress. But it's exactly like today, right? This is exactly what the Fed did. In 2017, it started to try to normalize rates. It raised rates, broke the economy, had to go back to rate cuts and quantitative easing. After the pandemic, we had inflation. The interest rates started being pushed up. The economy has been kind of cracking under that. We've seen unemployment raising. It's been slow, granted, but think about the amount of stimulus that they pumped in during the pandemic, right? And that's important because I firmly believe that the pandemic bailed out the Fed in 2020. It allowed the central bank to slash rates to zero and take quantitative easing to the unprecedented levels that we saw during the pandemic era. And it basically gave the drug addict as much heroin as it wanted, right? This kicked the can down the road, giving the easy money addicted economy a surge of its preferred drug and keeping the inevitable crash at bay. I'm convinced that had we not had the pandemic in 2020, we still would have entered into a recession either that year or the following year, just by virtue of the peak of the business cycle. And really, we don't like recessions, but it's kind of important because it cleanses out all of those malinvestments. And if the Fed would just get out of the way and let things settle out, we'd be fine. But they can't resist the temptation to rescue the economy. So we end up in this cycle, right? So we're starting to see the same pattern play out again, right? Analysts have noted that as the balance sheet shrank in March 2022 with the quantitative tightening, repo volatility reappeared, just like it did back in 2018 and 2019. First, on a month/quarter end basis and then more broadly. And this signals that reserves are getting closer to, as Reuters put it, less than ample. And so this is exactly why the Fed has pivoted back to quantitative easing, just like it did in 2019. So it remains unclear if these modest moves can stabilize the financial system, and if so, for how long. Again, as I've already mentioned, thanks to the pandemic, the scenario never played out in 2020, right? Were it not for the massive monetary injection during COVID, I'm certain the economy would have gone into a deep recession to cleanse that monetary excess out, just like I've already said. So instead, the pandemic allowed the central bank and the government to double down with stimulus, delaying the inevitable, but at the same time, making the bubble even bigger, getting the drug addict even more hooked to the monetary heroin. So, in other words, the economy never reckoned with the monetary malfeasance of the Great Recession era because the pandemic short-circuited the cycle. Instead, the Federal Reserve and the government doubled down and added more fuel for the inevitable economic fire. So, the reality is that the economy has to have its easy money drug, right? Without it, the addict goes into painful withdrawals. We've spent decades addicting the economy to this easy money. The Fed, which is the pusher in this scenario, has begun to dribble the monetary heroin back into the addict's veins through rate cuts, through the return to quantitative easing. The problem is, over time, it takes more and more of the drug to maintain the high. So eventually, if you keep giving a drug addict drugs, he eventually overdoses and it kills him. Of course, the withdrawals of taking the drug away can kill him too. So you kind of see where the Fed is, right? Damned if you do, damned if you don't. Doesn't want to kill its customer. On the other hand, it's got to be careful and keep giving it the drug. So here we are. So no matter how this plays out, we're looking at an increasingly inflationary environment. And really, that's the bottom line here, right? The Fed is, as we speak, loosening monetary policy. It is bringing us more inflationary policy. And as I've said over and over again, inflation is the plan. Now, you're going to hear pundits out there saying, oh yeah, inflation's going down. And it is, it's cooler. But that doesn't mean prices are dropping, right? It just means prices are going up a little more slowly than they were before. Inflation is the plan. 2% inflation, that's the plan. They want to devalue your money by 10% every 5 years. That's the plan, right? So the money supply right now is already growing at the fastest rate since July of 2022, and that was in the early stages of the tightening cycle. And the pace of money creation is only going to increase as the Fed continues QE, without calling it QE, and we'll also likely see additional rate cuts. So that means you can look forward to the purchasing power of your dollar declining even more rapidly. So that's what I'm really getting at. We are at the crisis point in the business cycle. We got there in 2019. It was short-circuited by the pandemic. The pandemic allowed the powers that be to double down on all of the policies that created the bubbles in the first place. So now we've got these massive asset bubbles along with massive debt bubbles, and the Fed's between a rock and a hard place, right? It needs to simultaneously cut rates in order to keep the bubbles inflated, to keep the economy rolling along. And at the same time, it really also needs to be raising rates, I would argue, to battle inflation. So you've got to plan accordingly. You need to have real money. If you're saving, you don't want to save in dollars. You don't want to save in a currency that is being intentionally devalued 10% every 5 years, right? You can't stay ahead of that. You want to have real money. You want to have gold and silver. And you're at the right place because at Money Metals, we have gold and silver, and we'll be happy to sell it to you. And we have plenty of inventory. You know, a lot of dealers right now are struggling with low inventory levels because, as you can imagine, sales have been through the roof over the last month or so. But we have plenty of inventory, and you can get what you want. And I'll tell you this, if you're looking at silver, and a lot of people are looking at silver right now, given the amount that it's increased, we have junk silver, which we're talking about dimes, quarters, half dollars that were minted prior to 1965. They're 90% silver. So they're worth a lot more than quarters, right? You can get these still under spot. It's the best way to get silver right now. So if you're interested in doing that, I'll link to our junk silver page on the show notes. And, if you have questions, if you want to talk to somebody, you want to figure out how precious metals can fit into your investment strategy, give us a call, 800-800-1865, and talk to one of our fine precious metal specialists. They can answer those questions for you. They can help you figure out what products are going to work for you. They can tell you about our programs that we have, including a monthly purchase plan where you can build your gold and silver portfolio slowly over time with as little as $100 a month. So give us a call today. If you know what you want, don't give us a call. Go to moneymetals.com and just order what you want. If you want to get some of that junk silver, or you want to get, silver rounds or whatever, bars, gold, you can do that online. We'll ship it right to you, or you can have it stored right in our vault. But do it today, because again, they're devaluing your money and they ain't gonna stop. So with that, we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up. Get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to listen to our Market Wrap podcast that airs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thanks again for listening to the show. I really do appreciate it. Remember, give us those reviews, those thumbs up, share the episodes. I will say thank you. Have a fantastic rest of your week, and I will be back again behind this microphone next Wednesday.